really making some moves. Shibani Sircar Kurian is with us, Head of Equity Research and Fund Manager at Kotak Mahindra Asset Management Company. She's our Alpha Manager of the day. Shibani, welcome to the program. Before I come to you, I just want to make a quick mention of what I think is a bit of a proxy to, it's like a proxy stock to hopes of US-India trade deal, rising or diminishing. I'm talking about Gokuldas exports. If you can have that stock up, I think about 8-9% as we speak, almost close to about 800 rupees. It basically was, it got smashed from 1200 to almost 720 or so. And today it is up 8.5%. Overnight phone call, that comment from Secretary Besant, and hopefully something, right? We'll see. But Shibani, as a fund manager, and we've heard this, right? Markets have not gone anywhere, but nothing is cheap. But you've got, event-related damage in Gokul, something like a Gokuldas, not just Gokuldas, KPR, bunch of other textile names. Is there an area, if it's a matter of time before it gets resolved, and you've got some comfort because of the event-related damage, do you think these are stocks, ideas that one should look at?
Yeah, hi Prashant. So of course, what's happening as far as trade and tariffs go, this is a period of uncertainty. Very difficult to take a call as to when this sorts out and in what form it sorts out. So therefore, from our portfolio perspective, what we have been trying to do is focus more on the domestic-facing sectors, where clearly there is a demand driver in terms of the policy push that we've seen, especially where discretionary consumption is concerned. Also look at sectors and spaces where valuations are still favorable, but there is upside in terms of earnings. So in that context, the few sectors that we have been positive on include the entire consumption pack, especially the discretionary consumption, which includes durables, autos, retail, and the like. We've also been positive on banks. We believe that while Q2 will be a muted quarter as far as banks are concerned, valuations are in favor, and Q2 should be a bottom as far as the margin pressure where the banks are concerned. So net from a portfolio construct perspective, like you mentioned, valuations are still not cheap, but in pockets, especially where large caps are concerned, we believe that valuations have become reasonable, and therefore tilt our portfolio from a risk-reward perspective towards large caps and select mid caps. And within sectors, segments such as consumption, banks, and pockets of healthcare. That's how we are positioned.
Shibani, hi, welcome to the show. If you had to just drill down a little bit in terms of the select mid caps within the portfolio, just give us a sense in terms of the sectors, the type of stocks that you would probably be looking at.
So if you look at the mid-cap basket as a whole, valuations for the mid-cap space still continue to be above long-term averages. However, what we have noticed is that the earnings growth trajectory for mid-caps, again as a basket, have been performing better than the rest of the market, and therefore there is earnings support. So within the segment, like I said, fairly stock specific, more bottom up in nature. The discretionary consumption pack, parts of industrials, for example, where we see, again, earnings growth pick up. So it's pretty much stock specific as far as mid caps go. But at a headline level, we still believe that risk reward is more favorable for large caps. We would slightly be underweight on mid caps and underweight small caps as far as a portfolio construct and asset allocation goes.
Shibani, is it time to take a real look at technology names? Even a conservative company like TCS realizes that perhaps organic growth is going to be very moderate, and now they are planning to be more efficient, a sharper focus on the capital that they own. And they just seem a little more aggressive, willing to, make some bets. We'll have to see how it plays out. But, given the intent, would you bet on technology names now?
So technology is a sector that we are closely watching out for. Of course, the sector has seen significant amount of turbulence, both in terms of demand coming off, as well as the narrative on the AI, which would possibly change dynamics for the sector. Our thought on technology is twofold. One, in the near term, there will still be macro challenges that the sector will have to face. However, as we were discussing, if there is a trigger that comes through in terms of a trade deal or a settlement on the tariff front, then there would be some amount of certainty or some amount of that turbulence possibly coming to an end. Secondly, of course, US macro and how the overall global demand pans out is important for the sector. Having said that, from an AI perspective, if you look at a slightly medium to longer term trajectory, our belief here is that Indian IT companies would possibly benefit with the transition and adoption of AI, especially at an enterprise level, where we believe that the amount of work that can come the way of Indian IT services players can go up meaningfully as more and more enterprises shift data to the cloud and also focus on getting their data arranged so that they can actually take advantage of AI. So structurally, we believe that IT players will continue to reskill their workforce to gain a part of this opportunity set that's coming along from an AI adoption perspective. Near term, of course, earnings are likely to be muted, and therefore that's the challenge for the sector. Here again, valuations have become fairly reasonable in context of its history. But until and unless growth comes back or there are signs of revival on growth, it is likely that the sector muddles through. But clearly, this is a sector that we will keep a close watch on. As and when things start to improve from a macro perspective, especially where US is concerned, or there is some stability or a trigger in terms of the tariff issue settling down, then this is a sector that can benefit.
Okay, all right. Well, Shibani, just wanted your thoughts in terms of the consumption space. We did see a couple of these companies come out with their Q2 updates. And let's in fact start with Titan, which surprised the street. The stock was up 3 to 4%. The street liked what it saw. And this is despite, gold prices being where they are. Would you be a buyer of Titan at these levels?
Unfortunately, cannot talk about a particular stock.
On a sector basis.
On the sector basis, this is a segment overall, as far as discretionary consumption is concerned, we have been fairly positive. Of course, the impact of the various policy changes that have been made, starting from the budget with the income tax cut, along with the GST rationalization, as well as the policy rate cuts, will be seen in the subsequent quarters. However, the feel that we are getting in segments, for example, two-wheelers, four-wheelers, parts of durables, retail, a lot will also depend in terms of how commentary pans out in this quarter. Of course, this quarter will possibly, as I mentioned, will not see the full impact of these policy changes. But net-net, we believe that the environment is fairly supportive of growth and demand. And therefore, consumption as a basket, especially discretionary consumption across various pockets, as I mentioned, should benefit. Some amount of that has also already been factored in terms of stock prices. But overall, what we believe is that in pockets, valuations are still fairly reasonable. And as earnings come through with growth and demand, especially going into the festive season and beyond, this is a sector that we remain fairly positive on.
Thank you, Shibani, for joining in. Let's now get a handle on what's happening in the future.